What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. In today's episode, I'm thrilled to have chief economist and global strategist Peter Schiff joining us. Peter's renowned for his outspoken views on the economy, particularly his unwavering support for gold and critical assessment of Bitcoin. With gold reaching unprecedented highs, we'll dive deep into its implications for the economic landscape and future trajectory. We'll also get Peter's thoughts on the market pullback, the Federal Reserve's evolving stance on inflation, and his forecast regarding the looming U.S. currency crisis. This episode promises invaluable insights for anyone seeking a fresh perspective on economic trends and challenges. Let's dive right in. Today's podcast is sponsored by TradeStation. Serious futures traders, level up your skills with TradeStation's powerful platform. Enjoy flexibility, superior trading power, and save big with 50% off brokerage fees for the life of your account. Open a new futures account today at tradestation.com/Anthony and get 10% intraday margin rates on 3 popular futures markets. Discover why TradeStation is my go-to platform for trading options on futures. Explore the robust platform now at tradestation.com/Anthony. Peter, welcome to the show.
Hi, Anthony. Thanks for having me on your show.
Great to have you on. Been following you for a lot of years, and obviously a very interesting time to talk about gold, because that's obviously we're going to focus on today. And thank you for giving the futures guys a little love here on the Futures Radio Show podcast. And as I said, it's an interesting time for gold, interesting actually day for gold. But you've been advocating for gold as the canary in the economic coal mine for quite some time. And this year we saw the gold market make all-time highs. And on one hand, we've had people saying that this rally in gold is happening because of geopolitical risks. You see a lot of people saying that, not as a hedge against the central banks. While on the other hand, you have some saying inflation is much worse than people think, and they're questioning the liability of the U.S. Treasury to service its debt, and that's why gold is rallying. I know you may be an advocate to both of those reasons, but Peter, is it one of those reasons that's the main one? Is it both, or is there more to the story here?
Well, I think that geopolitical risks are more of a canard. In fact, gold fell by about $50 today. And I think the catalyst was the belief that, the geopolitical risks are not as bad. You know, we had this retaliation. Israel was very limited, and maybe that's it. And so things are going to be settling down in the Middle East. And I think that prompted a lot of speculative selling in gold. But I don't think the geopolitical concerns have been the main driver of this rally. And I believe the real buyers are going to step back up as a result of this $50 pullback, and they're going to buy more gold and drive the metal to new highs. What's driving gold higher is inflation and the understanding that it's impossible politically for the Fed to actually stop inflation, that inflation is actually the lesser of the two evils in the Fed's mind. And so rather than a winning inflation fight that would cause a severe financial crisis and force the U.S. government to default on its debts and cut spending, the Fed is going to monetize debt and buy bonds and do whatever it takes to prevent those political choices from having to be made. And so inflation is going to be much higher than 2%. And that means gold needs to be much higher than its current price. And I also think that a lot of the central banks can read the writing on the wall. I mean, in many cases, they put the writing on the wall so they understand it, but that the dollar's days as the world's reserve currency are numbered, and the replacement for the dollar will be gold. And so central banks, seeing the vulnerability of the dollar and understanding that its reign is coming to an end, they are trying to replace dollars in their reserves with gold. And they have been big buyers of gold, and they will continue to be buyers for years to come.
A lot to dig in there. I want to go over today in particular, because you say that it's inflation, the fear of inflation continuing to stay hot is the driver behind the rally in gold. But yet today we see gold down. It was like 70 in the futures last time I looked. And like you mentioned, I do believe that the market was taking that as, things didn't get that heated between Israel and Iran over the weekend. So do you think that the 70 point plus move lower in gold today was maybe taking those weak hands out that were playing for the geopolitical side of things, and you think that this is another buying opportunity?
Yeah, I think some of the speculative. So if you're looking at the futures traders, certainly some of those traders got into it for the geopolitical aspect of it. But the real buyers that have been bidding up the prices are not the futures traders. And the real buyers are buying it for other reasons, not the reasons that commodity traders might be buying or selling it on any given day. I mean, most people who are in the futures market of taking delivery of any of that gold. They're just trying to speculate on short-term price movements. And if they think those price movements are defined by geopolitics, then that's what they're trading on. But the fundamental factors that have lifted gold to 2,400, right, 20% above 2,000, have nothing to do with that. And gold's going to keep on rising because the dollar and the euro and the yen and the pound are going to keep on losing value. Because, all these central banks are not going to raise rates high enough to put the inflation genie back in the bottle. And so you need an alternative to fiat currencies. And the only monetary alternative is gold.
You had this big bill in the U.S. House of Representatives passed on Friday. I don't know if I saw your Twitter channel and having you comment on that about that at all. I was coming in today just wondering if that was almost going to be offset because the spending continues, Peter, and I think that almost ties into all the things that you're saying, but it just seems like the geopolitical side just kind of overran it just today.
Yeah, well, the bill that was passed, another $95 billion spending package, $61 billion to Ukraine. And the Ukraine has already received upwards of 100 billion. So, this is a tremendous amount of money that is going to the Ukraine with no end in sight. Who knows? Maybe we'll end up sending $1 trillion to the Ukraine over the years. But this money is being borrowed. We have a ticking fiscal bomb here. And rather than diffusing it, we're just, making it worse. We're adding more debt. There was no discussion about whether or not we needed to pay for this aid, whether spending should be cut somewhere else in the budget or taxes should be raised. No, there's no consideration to where the money is coming from. Let's just spend it and we'll just run up the debt, completely oblivious to the debt crisis that is already looming, and we're making it worse. But it really sends a signal to the markets that Congress doesn't care. The deficit, the debt doesn't matter. The fact that we're spending over $1 trillion a year on interest doesn't matter. The fact that next year we'll be spending $2 trillion a year. That means interest on the national debt will be the single biggest line item in the federal budget. We'll be spending more on interest than we do on either Social Security or Medicare. But no one seems to care about this. And that trend is only going to accelerate until eventually 100% of tax revenues will be earmarked to pay interest on the debt.
But what do you believe this overall surge in gold prices is signaling about market sentiment and the state of the overall U.S. economy?
Well, first of all, gold's rise is signaling that the Fed policy is wrong, that the Fed is making a mistake in its contemplation of rate cuts. In fact, the Fed has not raised rates enough, and we need more hikes. But they've practically, or for all intent and purposes, taken those hikes off the table. Nobody expects the Fed to hike. The only expectation is, when are they going to cut? How many times are they going to cut this year? When are they going to start? But the conversation should be about hikes, but we're not getting those because, the Fed knows that the economy can't handle the higher rates. They can't even handle the rates that exist today, which is why the Fed wants to reduce them. So gold is sending a loud message. It's falling on deaf ears, but it's sending a message that monetary policy is too loose and that the Fed and other central banks need to raise rates, but they're not doing that. And it's also sending a message that inflation is going to be much higher than is generally perceived by investors. So I think the bond market has been selling off, but I think the bond market is still mispriced because they still think that Fed, quantitative easing program, when it eventually resumes, is potentially going to save the bond market. But I think it ultimately dooms the bond market because those quantitative easing programs destroy the value of the dollar, which is what the bonds ultimately promise to pay. So the bonds are only as good as the dollar, and a return to QE and skyrocketing inflation just assures the dollar is going to collapse in purchasing power.
So does that mean that you're bearish the bond market then?
Yeah, I mean, I think bonds are headed lower. I think the dollar ultimately is headed lower. I mean, it hasn't really started to fall yet, although it is falling. Gold tells you that the dollar is falling. It's just falling more slowly than the pound or the euro or the yen. But all these fiat currencies are losing value. Gold on Friday closed at a record high in every currency in the world. And, it pulled back today, but that's, no big deal. I mean, that's what happens in a bull market. You get a drop that scares out, the weaker players, the leverage players. But, there's no indication that the gold price is going to stop rising. And I think eventually it's going to rise much faster when the public joins the buying and even professional investors. There's very little institutional demand in the gold market. It's mainly coming from abroad, and a lot of it is coming from central banks, particularly emerging market, Eastern central banks. The West is not buying, right? The Fed, the European Central Bank, right? The Bank of England, they're not the ones that are buying the gold.
And so who is the one buying the gold? You say it's
Well, it's like, emerging markets, China, India,
China. Yeah.
smaller Southeast Asian countries, they're buying. Probably some South American countries and countries that have a lot of US dollar reserves that they need to, get rid of. So they're selling their dollars and treasuries and buying gold. And, they could get 5% yield on their treasuries, but they're willing to give that up to own gold because they recognize that yield is not high enough to offset inflation.
Yeah, no doubt. I mean, that is a trade, obviously. If you're taking dollars, you're turning them into gold. And so we're in a time where rates are going up and gold is going up and the dollar is actually going up. What are your thoughts about this environment
Yeah.
as a
Well, again,
whole?
the dollar is going down, but in
But
relation
not,
to,
yeah, but not much though, right? I mean, the dollar is not like it's not going down, I think, at the rate that gold is going up against the dollar. Or
well,
am I
I
wrong
mean, it
on that?
is. I mean, if you measure the purchasing power, prices are going up. So dollars today buy a lot yet less than they did a year ago. So the
Yeah.
dollar is losing purchasing power. It's just that when we typically think of the dollar, we think of it relative to another fiat currency, whether it's the euro or the yen or the pound. And if we see that the dollar has gone up relative to those currencies, we conclude the dollar is going up. But, if I'm in a car going backwards at 5 miles an hour and the cars next to me are going backwards at 10 miles an hour, sure, relative to those cars,
Yeah.
it appears that I'm going forwards, but I'm actually going backwards. And so gold is what's telling you all the currencies are falling in terms of gold. The dollar is just falling less than other currencies for now. I think that is going to change. I think at some point the dollar is going to start to fall more. And when that happens, you're going to start to see a much bigger dollar rise in the price of gold. But I think one of the reasons that falling bonds are somehow supporting the dollar for now is that as bonds fall, yields rise. And
Exactly.
those higher yields are attracting dollar buying. People think, oh, higher yields are good for the dollar. Bond yields are rising, so let's buy the dollar. But I think bond yields are rising because of inflation. And inflation is bad for the dollar because it means the dollar's value is going down. And it means bonds are losing value because bonds are promises to be paid dollars at some future date. And the further into the future you're going to get paid, the more bonds should suffer due to inflation. So a 30-year treasury should lose a lot more value because of higher inflation than a 1 year, because you have 29 more years of inflation to erode away the value of your principal.
So at what point do interest rates get high enough to where people start looking at gold and saying, well, let me turn that gold back into dollars and let me just capitalize on that short-term interest rate? Or do you just think that that's not the case?
No, because I don't think rates can ever get high enough to do that because you have to have real interest rates that would be high, not a nominal rate. And I don't think the Fed is going to get rates to a point where they're going to be high enough to offset what you lose to inflation, because such a rate would cause financial crisis. It would
Yeah.
render all banks insolvent. I mean, they're already insolvent now, but higher rates would just put them into insolvency. It would be much worse than what happened in 2008. And rates high enough to stop inflation would cause the US government to have to default on its treasuries. And so these are completely off the table for the Fed. The Fed is not going to put the government and the banks into that position. So the only way it can do that is not to raise interest rates or not to allow interest rates to go where the market would otherwise send them. And that means that inflation ends up being much worse. And the higher inflation gets, the more incentive people have to get out of bonds and buy gold.
From 0 to 10, how would you rate your confidence in the Fed to fight inflation?
Oh, 0. I mean, the Fed is creating inflation. That's what the Fed does. That's where inflation comes from. And so they're not going to fight the inflation that they're creating. I mean, that's been the Fed's game plan all along. I mean, quantitative easing is inflation. That's another word for inflation. Just sounds better. It's a euphemism. But the Fed's entire monetary policy has been to create inflation. In fact, they even told us that that was their goal. They kept saying that we don't have enough inflation, that the inflation rate is too low. That's a problem that we're going to solve. And they did. They kept creating inflation. But they're not going to withdraw the inflation that they've already infused into the economy, because that means everything that was built on top of that will come collapsing down. The entire phony recovery was built on the foundation of inflation. They built an economy that's addicted to artificially low interest rates. And so the Fed can't take that drug away without, a complete economic withdrawal taking place. And, if you look at the statistics, the Fed has raised interest rates to 5%, 5.25%, whatever it's at. But government spending is at a record. Government deficits are at a record. Household debt is at a record. Credit card debt is at a record. The higher rates have had no effect on reducing borrowing and spending. And so what that tells you is rates are still too low. The Fed is still encouraging reckless consumption financed by debt. And that is bidding up prices. In order to fight inflation with higher interest rates, the Fed has to stop the borrowing and spending. That's the effect that the rate hikes have to have. And if the rates are not high enough to stop people from borrowing, then they need to raise them some more. And they also need to encourage savings. They need to make the rates high enough that people want to save. But the savings rates are near all-time record lows. People aren't saving because the rates are still too low. The entire time the Fed has been pretending that its rates are restrictive, it's been the opposite. They've still been too loose. They're just less loose than they were, but less loose doesn't qualify as being tight.
Just today, I was watching people on financial media continue to say why the Fed needs to cut rates. They'd like to see just at least one. And of course, they're all talking their book, right? But I continue to hear this theme where people say the Fed needs to cut to normalize rates. What do you say to those people?
Well, they're defining normal as the artificially low rates that we had following the 2008 financial crisis until, 2021.
Yeah.
But that was not normal. What we have now is closer to normal than that. But I would still argue that rates are too low. Because if you look at where the Fed funds rate generally was, ever since, we went off the gold standard in 1971 up until the 2008 financial crisis, we're still on the low side of average right now. And I would argue that if measured correctly, inflation today, even though it's come down, is still higher than the average over that time period. And the fiscal position of the United States has never been worse. I mean, if you think about it, when do you get to borrow at a low interest rate? Everybody has, they have a credit score. You have your FICO score. And the more creditworthy you are, the lower the rate you get to borrow at. And that's because you're a better credit risk, because you don't have that much debt. If you have a lot of debt, the lenders are going to worry that you can't pay it back. Well, America is far less creditworthy today than it was 20, 30, 40 years ago. We have a lot more debt, and we probably won't default, but we'll inflate. That's how you kind of rank the creditworthiness of a sovereign nation that borrows in its own currency. Are you likely to create inflation to pay your bills and pay off your bills with the base currency? And the more debt you have, the more likely it is that you're going to monetize it. So given the fiscal position that the U.S. is in today, and that we're far more likely to try to inflate our way out of debt now than we were 20, 30 years ago, interest rates should be much higher to reflect that loss of purchasing power. So I would argue that given the inflation that we have and the prospects for higher inflation down the road due to our finances and our debt problem, interest rates right now should be historically high. And they're not even historically normal. I think they're still a bit historically low. So we probably should have a rate, I don't know, closer to 10% than 5%. I don't know exactly where it is. I mean, the market needs to figure it out, but it's clear that rates are still much too low. And that's one of the reasons I know that the inflation problem is going to get a lot worse. It's not going to get better.
So do you think that a recession is necessary to really to tackle inflation and I guess potentially stabilize the economy?
Well, it's not that the recession is necessary, but there's no way the Fed is going to fight inflation without causing a recession. And that's because of the phony nature of the economy that we now have. So it's not that under normal circumstances, you need a weak economy to get rid of inflation. It's actually the opposite. A strong economy fights inflation because a strong economy produces more stuff. Why do prices go up? Right? It's supply and demand. It's more money chasing fewer goods. Well, the stronger the economy is, the more goods there are to buy. Strong economies are more productive. And as you increase the supply of goods, all else being equal, that puts downward pressure on prices. So you want a productive economy. That is a good thing. It's when economies are not productive that you have more upward pressure on prices because you don't have the supply to meet the demand. The worst thing is when you have a weak economy and a lot of government spending and money printing. So you have more money and you have less goods and you really have upward pressure on prices. But the reason that we can't get rid of inflation without a severe recession is because we now have an economy that's based on consumer spending. And consumers are spending because they're borrowing. And a lot of the GDP is government spending now. But the only way to stop inflation is to reduce consumption. So government and consumers have to spend less. Well, if there is a contraction in spending, by definition, there's going to be a recession. I mean, there's just no way around it. So it's unfortunate, but that's the reality. We can't get rid of inflation without causing a severe recession. In fact, it would be a financial crisis. But the Fed is not willing to do what it takes. Despite its rhetoric, it stopped short. As soon as it really started to see some cracks, as soon as it saw these banks starting to fail, right? Signature Bank, Silicon Valley Bank, when these banks started to fail, the Fed stopped hiking, right? That's not a coincidence, right? All of a sudden, the cracks were there, the banking system was about to implode, and now the Fed stopped hiking rates. And it's promising to cut rates, because that's the relief that the overly leveraged financial sector and the government need. And the markets are already starting to price that in. And now, they're getting a little nervous because it looks like they may not get the drug as quickly as they thought or in as large a dose as they had hoped.
How do they tell everybody out there that, hey, we're going to cut rates, even though looking at the data, inflation still may be hot?
They'll be able to make an excuse that the weakening economic data gives them confidence that the hot inflation numbers will cool off. That's what.
So forward projecting, they're trying to get ahead of it, is what you're saying?
Yeah, because remember, the Keynesian viewpoint, which is incorrect, is that inflation is somehow caused by economic growth and employment, and that if you have a weaker economy and rising unemployment, that those factors in and of themselves will lower inflation. And so if we do get a meaningful rise in unemployment and a weakening in the economy, the Fed and a lot of other economists will assume that that means that inflation is going to go away and that they no longer have to fight inflation, that the recession will fight it for them. And now they can turn their attention to trying to stimulate the economy. They don't have to worry about inflation anymore because the weaker economy is going to solve the inflation problem. What my view is the weaker economy is going to exacerbate the inflation problem because it means less production, but bigger budget deficits, more government spending, more welfare, more unemployment, more food stamp benefits. So the budget deficits and money printing will go up as the economy weakens, and that will put even more upward pressure on prices, especially if the weak economy and rate cuts really cause the dollar to tank in relation to other currencies, which will help put even more upward pressure on commodity prices and all the things that we import.
I want to go back to the overall state of the economy. Higher interest rates have done really great things for a lot of my friends that have a lot of money. We're talking 8, 9-figure guys. They're making more money than they've ever made. They're spending a ton of money. I see it on a regular basis. I live down here in Naples, Florida. It's pretty pretty crazy how much Florida has, how big it's gotten, and how much spending I see here. Everyone's paying cash for homes. It's really pretty incredible. But yet you see on the lower end, they're really struggling. So part of me really sees two real separate economies. I mean, how do you look at the overall state of the U.S. economy?
I think it's terrible. And, inflation is a means to transfer wealth from creditors to debtors. And the debtors who win, like the US government, the world's biggest debtor, but they're people who own financial assets and have debt attached to those financial assets. And so they're enriched by inflation. So the wealthier people who have large stock portfolios or real estate portfolios, especially if they were levered up, they've seen huge gains in their wealth, certainly on paper. But if you're an average guy or gal and you rent, you don't own your home, and you don't have a stock portfolio, the only market that you're involved in is the supermarket, all you're seeing is your cost of living go up. Your rent's going up, your utilities are going up, your food's going up, your insurance is going up, and your paycheck isn't. And so people are relying on credit cards and they're tapping into their savings. Americans in record numbers are now moonlighting. People are working evenings, they're working weekends. People have multiple jobs just to pay the rent, just to put food on the table. The media, Wall Street is trying to convince everybody that the economy is great. But the people who actually live in the economy, they know it's lousy. Now, yes, some of the really wealthy people that work on Wall Street, right, that work in media, financial, they think it's great because from their perspective, yeah, it's pretty good because they're getting rich. But they're not seeing the world through the perspective of everybody else who's getting poor, right? Because it's just a transfer of what's going on.
So a two-part question about that. And I brought that up because my thinking is, if the Fed does cut rates, does that help that part of the economy, that part of the US with their struggles?
No,
So it doesn't. And so
no,
it
because
doesn't. Why?
it's going to fuel inflation. What we need is cuts to government spending. The government needs to get smaller. The inflation is the tax that everybody pays to finance government. And unless we reduce government spending, the poor and the middle class are going to get stuck with the bill. And so if we just print more money, they're going to suffer. And that's what we're going to have to do to get interest rates down. We're going to run bigger deficits. The Fed's going to be doing more quantitative easing. And so the price increases, which are the real, the root cause of the problem, or that's what people are responding to, the rising cost of living. When the Fed starts cutting, the cost of living is going to rise even faster.
Next part of that question was for gold, or for those people that are struggling in an economy. Should they be buying gold? And if so, how do you propose that they go about and get gold? Is it physical? Should they be putting it in, should they be buying the future? How should they be going about, protecting themselves?
Problem is, a lot of the people who are struggling don't even have any extra money to buy gold. I mean, they're spending all their money on rent and food and utilities, so they can't even afford it. I mean, maybe what they should just do is stock up on food, because, they should buy it now rather than buy it later when it's more expensive. And they can stock up on a lot of things. But, to the extent that you're not struggling to the point where you have some savings, you have some income that you're not spending, yeah, you absolutely should use some of that to buy gold or buy silver. You can buy physical gold and silver very easy. You can buy it from Schiff Gold. That's my company, schiffgold.com. Talk to the reps there. You don't want to be pressured into buying collectible coins or some fake numismatic coin. You want to buy bullion. That way you get the most gold or silver for your money, and you really get a inflation hedge and a store of value. And people who are more affluent, I mean, they should obviously own even more gold and silver to protect their wealth. And if they want to get a lot richer, they should join me and look at some of the mining stocks, which I think are dirt cheap because they don't really reflect the reality of where the price of gold is going. People still are skeptical of this rally. They expect gold to decline. They have no idea that it's about to increase several fold in price. And these gold mining stocks are today trading at a fraction of what I think they're really worth. And there's tremendous opportunity to buy them now before their true value emerges. I have a lot of strategies built around mining stocks. We have a gold fund that Adrian Day manages for me, the Euro Pacific Gold Fund. People can buy that fund at any discount broker. You can buy it no load. You can also buy it through us at Euro Pacific Asset Management. Europac.com is the website, EUROPAC.com. And we have separately managed accounts too. We manage portfolios that are focused on the mining sector. We also manage broader portfolios, international value and dividend paying portfolios. But if you're interested in the gold mining sector, we have portfolios specifically tailored to that sector of the market.
What about digital gold, Peter? There's a
Well,
joke
there is no
there.
such thing as digital gold.
I know. Yeah, well, you know
Yeah,
where I'm going next.
digital gold is like digital food. You can replicate an image of food on a computer screen, but you can't eat it. You can't have a diet of digital food or you'll starve to death. So gold is a physical element. It's a metal that has specific uses in the world, which make it valuable. And you can't replicate that digitally because you can't substitute Bitcoin for gold in any of gold's functions. Some things can be digital. Music can be digital because I can still listen to music. I can dance to it. I can sing along to it. I don't have to have a physical record. I could listen to digital music, digital photography. I don't need a camera with film. I can get an image digitally, but I still get the image. I still have pictures of my kids, right? I can still send them to my parents. They can see their grandkids, right? So it's like digital photography works. Digital gold doesn't work. I can't do anything with digital gold. I can't make any jewelry out of digital gold. I can't conduct any electricity out of digital gold. Digital gold in no way gives you what gold gives you. So it's all a marketing scam. It's just part of the hype to sucker people into a pyramid scheme.
So you knew I was going to Bitcoin with this, and I think it's been pretty clear your position on it. I don't think we need to go over that. I think people are pretty clear on it. I do want to go over a couple of things with it about the comparison, because right now is a time where we've seen both gold and Bitcoin surge to new all-time highs. And there is, once again, I see these charts, you know how everything is on X, it's a comparison. What is the better safe haven? Is Bitcoin a place to put your money in times of uncertainty? Is gold, which one's better?
The markets have already made it clear that Bitcoin is not a safe haven. I mean, if you look at what happened on Thursday night last week, when the news initially broke that Israel had retaliated and, it was launching missiles into Iran,
it was a risky.
What happened? Well,
Yeah,
the S&P went down 1.5%,
yeah.
and Bitcoin went down 6%. So Bitcoin went down more than stocks. So it's riskier than stocks. Gold was up 1.5%. It traded to a new all-time record high. So in times of uncertainty, when people are worried and they were looking for a safe haven, they were selling Bitcoin and buying gold. And, the same thing happened to Bitcoin on Saturday. Now, nothing happened to gold because gold wasn't trading, but Bitcoin was, and it went straight down. It didn't go up. So when investors are worried, they don't buy Bitcoin, they sell it. So Bitcoin is clearly a risk asset, which is what I've been saying all along. I mean, you're just speculating that somebody else will buy it at a higher price. I mean, there's nothing but risk. It's pure risk. It's digital risk is what it is. It's not digital gold. And of course, if it's not a safe haven, then how is it digital gold? Because if you're saying at least it's digital gold in a portfolio, people will acknowledge it's not digital gold in industry or jewelry, right? You can't use Bitcoin instead of gold, the industry. But people will say you could use it instead of gold in a portfolio. Instead of buying gold in your portfolio to hedge, you could buy Bitcoin. Well, if gold and Bitcoin do the opposite thing in response to fear or some political event, how are they substitutes? They're polar opposites. Bitcoin does the opposite of gold when it comes to safe haven. So it's not gold. And of course, it's not a store of value because there's no value that Bitcoin has that it can possibly store. The value gold has is its properties as a metal. Those properties don't diminish over time. But Bitcoin doesn't have any properties as a metal. It's not a metal. It's nothing. It's just a string of numbers. So the only thing Bitcoin has is a price. And you can't store price. Price is a function of just supply and demand. And you have no idea what the demand for Bitcoin is going to be in the future. And you know what the supply is going to be, right? Because that's known, right? We know how many Bitcoin there are. But we have no idea if anyone's going to want them because the only thing you want them for is appreciation. But they only appreciate if people want to keep buying them. But why will people buy them? Because they think other people will buy them at a higher price, right? So eventually the greater fool theory implodes and the price collapses. So, Bitcoin is completely unique from gold, but that, doesn't mean that the price can't go up, because the price of anything can go up, but people are dumb enough to buy it. And you can certainly trade Bitcoin, because it's possible that people will be dumb enough to pay even higher prices. And so you can make money trading on other people's ignorance and greed.
I want to share a story that I think really ties in with this. So I live in South Florida. You live in Puerto Rico, so you can relate to this story as well. I was here during Irma, and we lost power. And I was in a situation where all of a sudden we had to go and get gas, and you had to go and you had to pay cash. They were still able to pump gas. They had generators, right? Powered by fuel. But in that moment, I kind of had an aha moment when I look at my overall portfolio. I own some Bitcoin, I own gold, I've got physical. How would I be able to give someone a portion of my gold as a means to transfer for fuel or something like that, when in that moment with Bitcoin, I was able to, and I didn't do this, I used cash, but I thought I was able to transfer it like the exact amount. And so when I look at in a crisis situation that I was in, I was able to actually use something that had value. Whether it's a store of values, I think is a whole nother conversation for this, but I'm able to transfer it versus the gold I have. How was I able to give someone an exact amount of gold for goods?
First of all, if you get a real situation where the power's down, the grid or the internet is down, you can't transfer your Bitcoin either. I mean, assuming you found a gas station that wanted your Bitcoin, you wouldn't be able to transfer it if there was no internet, right? If there's no power. But on the other hand, if you had some silver coins, which would be more appropriate, you're probably not going to be able to pay for your gas in gold unless you have very small coins. If you have like a tenth of an ounce of gold, that would be worth $200. I mean, although you probably couldn't buy $200 worth of gas, although maybe you could. At that point, maybe gas will be expensive enough that you might need $200 to fill up your tank. But, silver coins right now, a 1 ounce silver coin is worth about almost $30. So, three of those would pay for a tank of gas at today's prices. So you can certainly hand that gas station owner 2 or 3 silver coins, pay for gas. But if you're talking about the ability to use a crypto token as a medium of exchange, gold, is ideally suited for that, because you could have gold. Any private company, any government can store gold and then tokenize it. And then instead of you taking the physical coins into your possession, you take the tokens that basically evidence your ownership of the coins that are stored. And now you can transfer those tokens to whoever you want. And so if you had $1,000 worth of gold, but you didn't own the gold, you owned the gold, but you didn't take delivery of the gold, you took the tokens. And the tokens were simply a digital representation of the gold that you owned. And you're owning those tokens was the equivalent of you, having a claim on that gold. Like if you go to a restaurant and you check your coat, and then they give you a claim ticket, that claim ticket represents your ownership of a coat. So you can go back and get it whenever you want. Now, in theory, you could give that coat check to somebody else who can though take it and take your coat, because now they have the claim, they have the ownership of the coat. It's kind of like a bearer instrument. They don't really check your ID when you take your coat check. They just look at the number and they go and they give you the coat that corresponds to that number. So you could have a digital, representation of your gold. And then if I had $1,000 worth and I went to a gas station and I owed the guy $60, I could just transfer him $60 worth of my gold. It would be a faster transaction, and it would be a cheaper transaction than Bitcoin. I noticed that Bitcoin transactions last night were taking over an hour to complete, and they cost $128. So how are you going to buy gas from somebody? Let's say you want to buy $50 worth of gas and you want to pay for it with Bitcoin, and it costs you $128 to give the guy the $50 worth of Bitcoin. I mean, that's not a very inefficient method of payment.
I agree with you on that. That was actually going to tie into what I was going to talk about, because I saw you put a tweet out about that, and I saw that going around social media. And just to clarify, at the time that I was doing that for Irma, we still had cell phones, and I guess the whole point of it was thinking I can actually give them incremental exactly what I want through digital. I know maybe we didn't have internet, but just the thought of it in a crisis of how I would do it. But
Yeah, but
you're
you
right.
could do that with gold too. You could tokenize gold and do the exact same thing, except there you're transferring something, whereas with Bitcoin, you're transferring nothing. So if I was a merchant and I was going to get paid for goods or services, I would rather be paid something than nothing. I would rather get gold for my goods than Bitcoin.
And does that exist actually, Peter? Or has that been
Yeah,
put
I
in?
mean, there are several tokens right now that are backed by gold. I mean, it's just that they're not that popular because the public doesn't want gold right now. I mean, the public has been selling their shares of GLD. They've been redeeming. The public wants to get rich. They don't want to own gold. They don't want to store value. They don't want an alternative to the dollar. They're looking for a lottery ticket to wealth. People are desperate, and so they're buying Bitcoin. They see Bitcoin, people say Bitcoin is hope. Yeah, it's like the hope of the hopeless. It's like you're in such bad financial shape that your only shot is to buy a bunch of Bitcoin or whatever you can and hope it goes to the moon. And that's what's going on. So, people aren't buying Bitcoin because they think it's a better money than the dollar or the euro. They just think they're going to make a bunch of dollars or euros if they buy Bitcoin. They just think the Bitcoin is going to go way up and they're going to be able to sell it at a higher price. That's what's driving it all.
Well, that kind of goes back to what I was talking about for the people that are struggling in this economy, a way to buy gold. Those are the people that are buying Bitcoin, right? And so what's an
Yeah,
easy
they shouldn't be. They're just, in fact, they'd be better off buying lottery tickets. But
Peter, we have a question from Sam Woodhouse. He's a longtime listener of my show, and he's a huge fan of your show. And he had mentioned to the group that you were coming on. This is a question from Sam. And he said, if you had control of the U.S. budget, what would you cut first?
well, I mean, I'd be cutting everything across the board. I wouldn't really spare anything, the axe. I wouldn't just cut, entitlements like Social Security and Medicare and government pensions. I would actually cut the debt. I would restructure the debt. I mean, I don't think it's fair to tell people on Social Security that you're not going to get what you were promised, but then tell people who own U.S. Treasuries, you're going to get everything that you were promised. I think everybody that the government owes money to needs to take a haircut. And so that means that if you own U.S. Treasuries, you're not going to get 100 cents on the dollar. There's going to be a significant reduction in what you get. Everybody's going to share in the pain when it comes to cuts. But, if you don't do that, everyone's going to share in even more pain. Inflation is going to wipe out more of the purchasing power of debt than what I would wipe out in a legitimate restructuring. People on Social Security are going to lose more of their benefits to inflation than they would lose if I were to be in charge and I were to cut their benefits honestly. Because the benefits are going to get cut either honestly or dishonestly. The honest way will result in smaller cuts. And at least, we can target the cuts. For example, I would eliminate Social Security completely for people of a certain means. So if you're wealthy, if you have assets or other income, then you lose all of your Social Security. And that means that some people who are really dependent on Social Security will lose less, right? But if the government just creates inflation, then everybody loses the same. Warren Buffett takes the same loss as any normal person. So the pain is shared equally, but obviously it's not equal when you're talking about people who depend on Social Security for a living and people who use their Social Security money, to pay the bar bill at the country club, right? There's a big difference there.
If you were Fed chair tomorrow, what's the first thing you would do?
I would announce to the world that the Federal Reserve is no longer in the business of fixing interest rates and buying government bonds, that I was going to embark on a program of rapidly winding down the balance sheet as quickly as I could, but that going forward, there would be no more quantitative easing and interest rates were going to go wherever they go. And the Fed was simply going to allow the market to set rates and not interfere in that process. And just let everybody know there's no more Fed put. If things fall apart, the Fed is not there to bail anybody out. We're not going to be printing money, creating inflation. The goal of the Fed is to protect the purchasing power of the dollar. And that's it. I mean, ideally, I would like to dismantle the agency and resign if that was something that I could do and, allow the market to go back on a gold standard. In fact, maybe I could kind of adopt some kind of quasi gold standard on my own. And, but we have to have a radical change in the policy that we have now.
Looking ahead, Peter, as we close out today, where do you foresee gold's trajectory in the next 5 years, even the next decade?
Well, I think gold is going to be remonetized. I think gold is going to replace the dollar as the primary reserve asset for central banks. I mean, gold was the primary reserve before the dollar. And even while the dollar was the reserve currency, it was gold because the dollar was as good as gold. Because up until 1971, from Bretton Woods until 71, if you had $35, you could turn them in and get an ounce of gold. So it wasn't that the dollar was backed by gold. The dollar was gold. The dollar was defined as a weight in gold. Federal Reserve notes were merely IOUs that obligated the government to pay real dollars, which were made of gold. And so that ended in 1971. And I think it's been a disaster for the world to have gone on this, fiat standard. So I think we're, in the early stages of the transition back to gold. And so over this period of time, whether it's 5 years, 10 years, I don't know for sure, but we're going to transition. And I think that's the main reason that foreign central banks are accumulating dollars. They are preparing now for that transition. They are trying to increase the gold that they have in reserves. And they're going to continue to do that. And eventually the de-dollarization process will be complete. And it has profound implications for the world, particularly for the United States.
Peter, I can't thank you enough for joining me today. I've learned so much from you over the years. It was absolutely awesome to get a chance to speak with you in person. Let everybody know where they could go to learn more about you, your podcast, and everything you've got going on.
Yeah, sure. So I do my own podcast, the Peter Schiff Show podcast, generally once or twice a week, rarely, sometimes it's 3, depending on what's going on. But you can listen to it on my website, schiffradio.com. You can also listen on my YouTube channel. You can subscribe to my YouTube channel so you get the alerts when the podcasts are going to go live. You can follow me on social media. I'm on Facebook, Instagram, TikTok, X, formerly Twitter is where I am the most active. I do all my own posting.
Well, I follow you on X. That's where I watch most of your stuff come through X. I know it flows through there. We have a majority of the people that are on this show are coming through X. So I think most of everybody should definitely go and follow Peter on there. Peter, once again, man, I can't thank you enough. So much fun. Great to get a chance to chat with you, to meet you. And it's always interesting hearing your perspective. I mean, you tell it the way you see it. And I love that about you. And I think that's why so many people follow you and like you as well. So thank you again, my friend.
Yeah, even the people that hate me, they kind of love to hate me. So, but anyway, yeah, thanks, Anthony. I really appreciate the time on your program and the opportunity to address your viewers, your audience here. So thanks a lot.